first discussion will be on the various investment options that you have for gold. As Indians, we love gold, and the day to shop this precious metal is near. That is Akshaya Tritiya, which is on 3rd of May. Each year, we see so much of rush in all those jewelry shops, but this year, let's go with the theme and let's go digital. With inflation on the rise, and definitely gold would be a good hedge. What all are the digital options available in the market when it comes to investing in gold, and how much returns and what would be the tax implication of them? Let's discuss and explore all of these options with Mr. Santosh Navlani, who is the COO of ET Money. Thank you so much, Mr. Santosh, and a very good evening to you. And thank you for joining us today at ET Now. Firstly, we'll try to explore more on the various options that are available. Firstly, let me get you to the point of inflation, because historically we have seen that gold has proved to be a good hedge when inflation is going just above the roof. We see the numbers at record levels as of now as well. This particular year, do you think in such a scenario it is a good time to invest in gold? And apart from that, what all factors do people take in consideration when they look for investing in gold?
Hi, Srishti. As you rightly said, gold is looked upon as a hedge against inflation. And with inflation rising across the world economies, including US and India now as well, gold actually is showing some kind of uptick after the lull in 2021. So we actually believe that gold can be added to one's portfolios as a hedge. How much it all depends upon one's risk appetite, one's overall allocation to gold in the form of physical investments, or generally what one's appetite is in terms of staying with equity investments versus hedging some of the portion of it by buying gold. On the aspect of multiple investment options, as we are progressing as a country, there are probably much more options available to Indians today to invest in gold compared to what used to be in the past. The latest entrant over the last few years being digital gold and sovereign gold bonds. And we can discuss in detail as we move towards show. But there are very interesting opportunities to invest in gold in the form of SGBs, as it's called, or generally gold ETFs as well.
With you, Santosh, but firstly, let me take you to the point of the very basic, that is the physical gold. Because why do you think that people should not go for it? And in comparison to that, when they're looking for options like digital gold, what's there in the box?
So, Srishti, if you look at gold from a consumption standpoint, then of course there is no other way to consume it except buying physically. But the moment you are very clear that you're buying gold for investment purpose, it doesn't make sense to really block your money into physical gold, because the moment you're buying as physical gold, a couple of other costs come along tagged with it, which are unwanted for any investor for that matter. So one of the first costs that you will actually end up having when you buy a physical gold is going to be 3% GST. It goes, the moment you buy gold, you're down 3% on investment value immediately. Along with the 3% GST, you will also be suffering from taking the overhead cost of managing investment in form of storage. There's also risk of theft always being there. So you may have to resort to a bank locker or things like that. Again, it will be additional expenditure on that side. Typically, it can vary from a few percentage points to as high as 5% as well. Sometimes there are always costs when you go and liquidate the physical investment and want to encash that investment for yourself. In the typically jeweler or any kind of physical shop will kind of deduct some amount of money in form of impurities, typically about 2 percentage points on that count. And if you are converting into jewelry, again, you are kind of making charges on it. Can be 7%, can be 10%, depending on the jewelry shop you're going to. So if you look at physical cost of physical gold, you are actually eating up in some form of returns in by taking those costs into it. And gold is not something which you can have a very, very predictable rate of return when you buy them, when you buy it. Simply because gold, while it is not as volatile as equity investments and is probably has not enough drawdowns as well, it can typically test your patience at times when it refuses to move anywhere. But you can't be sort of 100% sure that it is going to generate a return for you. So basically investing in physical gold and taking these costs on your head when you're not sure about the returns of the future may not be worth the investment to make in life.
Okay, thank you so much, Santosh, for highlighting all of these factors why one should not consider accumulating gold in the physical form. But let's switch the opposite way and talk about the digital gold. Firstly, what is digital gold? Can you please help our viewers understand this? And we see that it includes charges like GST of 3% on the purchase and even spread. What is spread about and how it's going to impact the pricing?
Sure, sure. So, if you're willing to move away from physical option of accumulating gold, Srishti, then one should basically look at what all multiple options are available to invest in gold digitally. One of them is digital gold. There are other forms, which is gold ETFs, gold mutual funds. It can be also sovereign gold bonds, which I believe are one of the best ways to invest in gold. But sticking to digital gold in pure form as buying in as any kind of investment, people buy it as low as rupees 100, rupee 1 in some of the apps as well. There is, as you rightly highlighted, there are cost of GST associated with it, which is 3%. And there is cost of spread, which actually is very, very hidden cost that people actually don't notice easily. So you will notice that when you're buying gold in physical, in digital form, like a digital gold, you would notice that the difference between the buying price and selling price can be as high as 5 to 6% depending on the app. So you're not only foregoing or basically expending a 3% cost as tax in the form of GST, you're also basically going to be sure about one aspect, that when you buy gold today, it is going to be a bit expensive than the market price. But when you're going to liquidate that money in the future, you'll probably be kind of getting less than 5% less than the actual fair buying price that day. So you actually are always assured of 3% immediate loss and 5% loss in the future. And your return, if you're holding it for small periods of time, like 1 year or 6 months, then it may be not the kind of most prudent way to invest, as we talked about physical as well. Apart from that, personally at ET Money, we believe that there is a need of regulatory oversight in these way to invest. The digital gold is neither regulated by SEBI nor regulated by RBI. So one wouldn't really know 100% sure with surety that actually the storage, the safety of the gold or the purity of gold is completely guaranteed to be absolute best, as one would have probably imagined. So this 5% cost that they're taking sometimes is taken in the form of they have a cost of storage, cost of technology upgradation, cost of transportation and things like that. But the fact is there is not much difference between physical and digital gold if you add up all these costs into the picture. So we believe that apart from regulatory oversight, which is a big overhang in our opinion, digital gold is not the best form to invest money, simply because of this 8% cost that you're going to have indirectly when you invest in gold digitally.
Absolutely, Santosh. Totally get your point, and thank you so much for highlighting this for our viewers, because this is a very new buzz that has been creating around digital goals, and what are the cons of investing in that. That might be really helpful. But now another form of investing in digital gold is ETF. Help our viewers understand, like, how should one go about it, and where do you place them in comparison to the other options that are available for investing digitally in gold?
Sure. So I think one of the best ways, or probably easiest, one of the most convenient ways, can be actually investing in the form of investing in gold from the mutual fund companies. It can be offered in two ways: gold ETFs and gold mutual funds. Sticking to gold ETFs, they are basically as easy as buying a unit of share or a stock on the stock market from your broker. They are listed and traded on daily basis in the marketplace. Another advantage is when you're trading a single unit of ETF onto the market from your brokerage account, you are sure that there is an underlying gold available under these units. So you're basically trading gold in real form. And the only cost that you'll incur is basically a demat account opening / maintenance cost, which most of us have demat accounts for our equity investment. So there's not additional cost that you're actually expending because of buying gold ETF. There is a brokerage cost involved. There are a lot of discount brokers available in the marketplace, which people actually traded. So you practically may not be paying any kind of cost in buying gold. And there is the possibility of a cost in the form of, basically when you sell gold, gold. There can be in the form of the debit charges from a depository account and things like that. So and those are very flattish costs, like a 13 rupees or 13.5 rupees plus GST, irrespective of the amount of units that you trade in gold. So there is a cost of basically management fee or expense ratio in the form of the fee that the mutual fund company will charge, which is about 0.5 to 0.6% most gold ETFs. And that is a recurring cost. So you should keep in mind that this is almost a cost which is getting billed every year to you. So if you're holding gold for 1 or 2 years, it may not make a dent in your returns at all. If you're holding for 10 years, again, it may not make a big dent in your account. If you're holding for like 5 or 6 years, then it may just become that you probably saved money in the form of GST, you probably saved money in the form of storage cost and spread. So if you look at it, the total cost of owning gold ETF or gold in the form of ETFs is probably far more cheaper compared to the physical gold or digital gold, because you don't have to worry about storage or theft or impurities at all. Plus the additional aspect being you save on GST of 3%. So compared to when you buy a physical gold or digital gold, you're 3% down immediately. When you buy digital gold in the form of ETF, you don't actually go down by 3% because there is no GST involved in that. Plus, you have an oversight of SEBI. All brokers in the country are registered or regulated by SEBI. There are strict guidelines about how these get traded in the marketplace. They are managed by mutual fund companies. There is underlying security in the form of physical gold, which is being stored somewhere, and there is a proof because of which these units are being traded there. So it's one of the safest way, or rather, I would not safest because there is always market risk involved in the price of gold, whether you buy physical or digital or ETF. It's basically one of the safer way to buy because you would know you will not get conned in the process anywhere.
Okay. Now, Santosh, talking about gold bonds, because recently they are also been gaining a lot of traction, and they have dual benefits. Firstly, in terms of the asset appreciation, if there's any, and the secondly, they do hold a fixed return on this particular investment. But as an investor, what kind of return that I should be expecting from gold bonds?
So, Shashi, we should understand that the returns that you're going to expect are going to be similar in all the options. It's about the cost of owning the asset, which actually makes some of the options being better versus the others. So, the price of gold actually is the price of gold that you'll buy from digital gold, physical gold, ETFs, or sovereign gold bond is typically reflective of the real gold price in the marketplace in that sense. So returns are going to be similar. As I mentioned, the cost is which adds up to a bill which gets deducted from your returns is what you should look at. So when you buy sovereign gold bond, in our opinion, is the best way to invest in gold. There are only two problems here. I would not say problem, but I would probably say that there are limitations here. Is that you have a lock-in of 8 years that when you invest in sovereign gold bond, you will lock in where for 8 years you can't sell that kind of underlying unit that you get, and the aspect that if you want to exit, then there is no liquidity available easily. So when you are investing in sovereign gold bond, you should invest only when you intend to hold it for 8 years of the maturity period, which is there for sovereign gold bond. Another disadvantage or limitation I would call in sovereign gold bond is its availability. So RBI comes with these bonds periodically, and while the dates are announced in advance and you would know when the next tranche of sovereign gold bond is going to hit the market, the fact is if you wish to invest today and a new tranche is not available, then you would not be able to invest. And if you go and buy from secondary market where people sell and trade in these on the stock exchanges, the problem is that liquidity may not be enough to give you the fair price. So the seller may extract a higher premium because a buyer is desperate to buy that unit of gold today. So the lack of liquidity is how I sum it up. The lack of liquidity during the 8-year period is a problem. Though there is a window available after 5 years by RBI where you can surrender the units and get it back in cash it basically. So these are the kind of limitations. But what trumps sovereign gold bond is the best way to invest. If you wish to invest for long term and for 5 to 8 years kind of period, then the thing is, if you hold till maturity, then the gains are completely tax free. And second aspect is you basically get 2.5% assured guaranteed interest on your investment value, which no other gold investment option allows you. So a 2.5% annual yield, almost like a savings bank account, and a kind of tax-free return after 8 years is like a very, very sweet deal. So people or investors who are looking to accumulate gold for a very long-term period for personal consumption in the future, for people, Indians still spend money on gold on the weddings and things like that. So it's one of the best ways to accumulate gold in the form of sovereign gold bonds. And second, which comes is gold ETFs, and of course third is gold mutual funds, is how I put it. The only advantage of tax-free returns is available in sovereign gold bond, and no other option is there if you want tax-free return.
Thank you so much, Mr. Santosh, for highlighting all the options that are available when one is looking to invest in gold. But now let's talk about how you should go about investing in gold, because it is usually said that 5% of your total income should be dedicated to gold. So one should stick to just one form of the digital gold investment options that we just discussed, or over here also one can look to diversify. What's your take on this?
We don't believe in these kind of thumb rules in today's age, Shrishti, that one should always dedicate 5% of one's portfolio into gold. As I said, it's all more about one's risk appetite and hedge. As if you look at history of gold returns, there are while gold is less volatile than equity, the fact is there are periods of extremely high returns and period of no or other flat returns altogether. So it's not a permanent thing that is reserved in the portfolio always. People keep expecting that gold will rise and it may not rise. So look at it from a perspective that if you wish to invest in gold for your long-term goals, future consumption for wedding or things like that, then you should go ahead and buy gold, some kind of permanent part of your portfolio, like 5%, 3%, 2%, whatever it may be. But I don't see a need to diversify this. If you're long-term, 8 years plus, sovereign gold bonds really work out well for you, condition that you're open to lock in there. Apart from that, if you can't afford a lock-in of 8 years or 5 years minimum that is there, you should possibly go and stick with a gold ETF or a gold mutual fund, in our opinion, simply because there is no cost involved. The cost is very, very minimal. There is no GST involved in both these options, so you actually are in profit from day one, or rather no loss from day one. And they are completely regulated by SEBI, where there is at least a regulatory oversight on the operations of how these funds are offered to the marketplace. So I don't see need of diversification. If you're long-term, stick to sovereign gold bonds. But if you're not long-term, not open to lock-in, then gold ETFs and gold mutual fund are enough for anybody in the marketplace today.
Okay, thank you so much, Mr. Santosh, for joining us today on ET Now. With this, it's a wrap to this discussion. And a big thank you for highlighting all the options that are available when one is looking to invest in gold.
Sure, my pleasure. Thanks.